This is Michael Fox, and this is the Prospector News Podcast. And joining me once again, we have the national investors, Chris Temple. Welcome, Chris.
Hey, Mike, how are you?
I'm doing good. Summer's arrived, and so is the summer doldrums. But I think we've got half a year behind us now. We can probably do a recap of what's been going on this year in the markets, where we are right now, and where we could be headed.
Yeah, and it's been a very different character to 2023 compared to 2022. It's almost inverse image. Last year, of course, the broad stock markets were down a substantial amount. Some commodities did well, some of them, of course, more than others. And that was, of course, as the Fed was raising interest rates, as the dollar was moving higher into the late summer, et cetera. And this is a different time. The dollar has absolutely collapsed in the last 8 or 10 trading days, especially. Interest rates, after breaking higher on the long end, have turned tail and now fluttered back down a fair bit. That's a work in progress. And I think the bottom line, especially after this week's breathlessly awaited CPI and PPI numbers, Mike, is that the markets are buying ever more into this notion that even though they're giving the Fed one more freebie as far as a rate hike that's still universally expected toward the end of the month here, they're thinking that that's going to be it, and that the Fed is going to choose to sit on its hands after that. We've got a long glide path to a soft landing, which is something the Fed has almost never achieved, may not this time, but that's the way that the broad markets are betting with their money. And the momentum chasers, the Pollyannas, are carrying the day. We've had a new yearly close, high close for the NASDAQ. We're going to get one for the S&P 500 now. The Dow's a little bit of a laggard in that sense, but even, you got to admit that the rally has even broadened out a bit in the recent past. It's not just a handful of the old fangs and similar stocks, but a few more of them are starting to participate. So some are saying this is a blow off top and they're going to fake everybody out. Some are saying no, that this disinflation trend and the Fed achieving a soft landing are going to endure. I think that latter narrative is going to be with us for maybe a little bit longer than I would have believed, but we still are going to go to a place where we're going to hit a wall and we're going to realize that all of the accumulated debts are catching up once more with consumers and businesses alike, and we're going to have trouble. It's just taking, because of all the liquidity that we started this whole fiasco with, going back a few years ago, Mike, there's still a lot of that liquidity out there. And this is going to play out over even a longer period of time than I suggested the last time we spoke.
I don't disagree with you. I see storm clouds on the horizon, and I think the longer the markets seem to think that we're going to be heading for a soft landing, the more likely we're going to see a trapdoor open up and the bottom fall out of things. Off camera or off mic, before we started, we talked about, our respective histories being in tornado alleys. And one of the things that I said, I learned at a very young age, is that if you look at the tornado and it doesn't appear to be moving, you're in real trouble because it's coming right at you. And I'm thinking the markets are looking at a non-moving tornado and don't realize they're in trouble.
Well, it's probably true. They thought that they were in some trouble back a few months ago, and we had a few bank failures. In the US, we had a couple in Europe, Credit Suisse most notably. Deutsche Bank survived to live a little while longer, as it turns out. But that's even a distant memory right now. The banks are in better shape, we're told, than what we thought. I commented in another mid-year assessment of things that I did several days ago, a video with a lot of graphics and stuff that's on my YouTube channel for people that want to look at it. I commented then, and still very much believe this, that this recent stress test that the Fed did of 23 major banks, showing that in most likely bad scenarios for a bad recession, some kind of a crisis and whatnot, that even though they lost a fair bit of money, all of these 23 major banks still survived. That's going to give the Fed license going forward to keep interest rates high. And that's the part of this equation that I think that the markets, with their exuberance right now and the tech stocks ripping higher and so forth, that they just don't get. It's one matter that after maybe this one last rate hike, as it's probably going to turn out for the foreseeable future, this month, that the Fed's going to pull off, that they're done. That's one thing, but I don't think the markets are wanting to reckon with the reality that interest rates are going to stay up there for quite a while. I mean, you're talking Powell, in one of his public utterances in a recent past, was suggesting that they're not going to get to their desired core inflation rate until 2025 at the earliest, and may not reduce short-term interest rates until we're getting closer to 2025. Forget about it happening this year. And I think that you still have this muscle memory in markets, as I've termed it before, where, okay, we got softer inflation numbers still, but higher than we've had to deal with for a long time. But that doesn't matter, because this all seems to mean in some people's minds that the Fed is going to start cutting interest rates, that the worst is over. And it certainly isn't. They're going to keep these rates up for quite some time to come. They're going to continue to roll off their balance sheet. And the other thing that's, despite the Bank of Japan helping the Fed, with some of their own interest rate suppression, because the Bank of Japan, of course, has been notoriously expanding its own money supply for quite a while. And a lot of those new yen are going into other countries' paper. But what about all of the new issuance beyond even that? I mean, it wasn't but a couple or 3 weeks after that recent deal between Biden and the Congress to increase the debt ceiling, that there was 800 plus billion more in treasuries issued in a few weeks' time. And that's not going to change going forward. It's going to get worse. So, I think that everybody is caught up in the moment, that we're just about at the end of rate hikes, but that's just one of several pieces of the Great Stagflation going forward, and everybody is ignoring the others, at least for the time being.
I'm in full agreement with you. To stay on this disaster, I know it's almost like a disaster movie theory, but when there's a tidal wave approaching, the tide actually goes out, and people are lulled into this false sense of security before the big wave hits them. And I think we're in that moment now in the inflation rate, because first off, prices are continuing to skyrocket. Like, if you took let's use a 4-year model here, where you had a basket of goods that were $1 in year one, they're $2 in year two, $3 in year three, and $4 in year four. So the price has gone up consistently over 4 years. Your rate of inflation in year one's 100%, followed by 50%, followed by 33%. So your rate of inflation is actually going down, yet the prices are continuing to rise, in an equal amount from year to year to year. Now, where this hits the road, let's say, for example, the consumer has $5 worth of income, and that basket of goods counts for their rent, their food, and all their necessities of life. So in year one, they had $4 of disposable income. In year two, they now have only $3 of disposable income. In year three, it's $2. In year four, it's $1. So their ability to buy other goods and services start to diminish unless they start to get raises. And those raises are inflationary, because they start to add into the cost of goods and services and start to push them up at the same time. And I think we're seeing that right now. there's port strikes, there's railway strikes, UPS is going out on strike, and everybody wants more money because the cost of living has been increasing dramatically, and they need to get themselves back out in front of that, and that's going to push the cost of goods and services up further. And that's not even looking into the energy markets. Last I checked, oil and gas had hit $80 a barrel again, and the price of gasoline at the pumps is starting to edge up again. And as you know, energy flows through the entire economy and every bit of it, and is inflationary. And then the third animal, as we've alluded to already, is the US dollar index is declining, and today it dropped below the 100 level. That means your US dollars is buying less goods, and that's inflationary. So you've got these three, kings of inflation all marching opposed to what the market says is going to happen.
Well, you're right, and let me second a few of those things that you brought up. First, your first point was the most important one. That yes, that rate of inflation is slowing down, but if you go back to right before the COVID pandemic, the price level, the general price level on headline inflation in the US is 19 point some odd percent, use a round number, 20% higher than it was going into 2020. So in a few years' time, that's the higher threshold of costs of everything, averaged out, if you believe the government's numbers too, that the average household is experiencing. And as you also pointed out, that's at the same time that while wage growth has still been better for a while now than it was for so many years, it's still not enough to keep up with that level. So real wages have been going down. What has kept consumers alive somewhat is, number one, they have been a little bit, they've been using some discretion and some better choices maybe, or more enjoyable choices in what they spend money on. Delta Airlines today reported record profits. They're swimming in money. The CEO this morning said he doesn't see that changing through the end of this year. But yet you look at retailers, and a lot of the retail stocks are in the dumps, and retail sales are way down. They're even down in nominal levels. Forget inflation. Same store sales for the nation's retailers just went negative. That hasn't happened since the last recession of significance. So, you've got this kind of mixed bag out there. And Jeremy Siegel, who's a professor at the Wharton School, he's one of the more noteworthy perma bulls on Wall Street, but a little bit more reasoned than some of them. He was out a couple of days ago talking about how he thinks that what is left of strong consumer behavior is really going to hit a wall shortly. His term that he used was, you've got the YOLO spenders out. YOLO standing for you only live once. And they're at the end of their excess credit, some of the savings that they banked from all of the stay-at-home checks here in the US, some higher wages and the rest of this stuff, and whatever else they can get on their charge cards, because despite the Fed's rate hikes, consumer credit has still been very plentiful, probably too much so in the US. And everybody is, pretty much spending or borrowing the last dollar they're able to right now. And then it's going to be reality check time in a much bigger way than just deciding between travel and buying a new refrigerator or buying a new, some new clothes. It's going to be cutting back on everything. And we will get to that point by next year. And that's going to introduce a whole new, different set of circumstances, because as the economy does decelerate and we probably shoot past the soft landing as things look now and go into a recession, prices are still going to be high. And the biggest reason is going to be, I believe, because of energy. I've been saying that for a while, that and I've got a big section in my upcoming issue on this, Mike. You've had a lot of one-off aberrations that have kept the price of crude oil down for, on and off, even in the 60s recently. And structurally, that is just not sustainable. And unless you think we're going to not only bypass the soft landing, but we're even going to bypass a recession and go into a global depression, the die has already been cast for crude oil prices to get back to the better part of $100 in the coming, probably not very many months. And especially if we don't get off with the unusually mild winter that much of the world had last year, and we have even a normal winter come back, that's just going to accentuate this, and it's going to push those inflation numbers back up. We may not at this point go back to near 10%, year over year inflation like we had last year at one point. And in fact, you got to keep in mind too that the comparisons are getting easier. Back to one of your points, yeah, we're up as far as the core CPI 4.8%, year over year, but that's 4.8% higher on a much higher number than what people want to admit. So anyway, you and I are in agreement on that we may have seen the high nominal levels for inflation, but I think we're, by the year's end, only because of energy, we're going to be back up to where headline inflation is going to be 4 or 5% again, not 3. And here again, this is something that the markets, with their behavior right now, are just not acknowledging the possibility of whatsoever.
No, I don't disagree with you. And as I say, if you start to get some of these wage settlements start to add into that, and it starts to drive the cost of
Right.
labor up, you're going to see an inflation rate that's even higher, I think.
Could be,
But
you add the United Auto Workers into that mix too, that you listed.
yeah, well, and the other thing is they take food inflation and they undervalue it in the CPI index dramatically. And I can, using a restaurant index kind of idea colloquially to know, like, I travel a lot for my work, as you know, so that means I have to eat out a fair amount because you can't cook in a hotel generally. And I've noticed that when I'm going to the restaurants, not only the price is going up, they have less staff working in the restaurant, and the portion sizes have been diminishing. So you've got inflationary pressures driving onto that business on 3 different fronts. And if the food prices remain that way, that's going to start to really reflect on, Joe and Sally soccer mom 6-pack that's out there, and they're trying to decide where they're going to spend their money. And just recently, the CBC did an article of this poor single father in Vancouver, and I say poor with tongue in cheek, but he's earning 75 grand a year after his take-home pay. And he's looking at rents that are more than what his take-home pay is for a 2-bedroom for him and his 16-year-old son in Vancouver. Forget discretionary. He's trying to put food on his table and keep a roof over his family's head. And 75 grand is a pretty decent wage. The mean wage in Canada is around 48,000. So he's making better than most people. And I'm of the opinion that some of these so-called disruptive technologies are just canaries in the coal mine. We have Uber drivers, we have Airbnbs, we have people day trading because they're not making enough with their day jobs to be able to afford the basic roof over their head, food on their table that they need to get by. So they all need a secondary hustle.
Yeah, and again, I think that consumers and a lot of small businesses, for that matter, too, going forward, are going to start to feel more so in fairly short order the lag effects, as they call it, of all of the Fed rate hikes to this point. And I think it's not only the rate hikes, but again, the big tax being this 20% or so higher threshold of what day-to-day expenses cost that we've had come about in just the last few years. So it's going to bring even that much more sobriety into things. It's going to be interesting to see how and where this butts up against a lot of liquidity still in asset markets, which continues to push rents higher. You have at least had, and this is one of the reasons for the lower inflation numbers the last couple months or so, there finally has been a notable softening of especially used car prices in the US. So that has provided some help if you're going to buy a used car, that is. Maybe not if you're not going to buy a used car. But here again, I mean, you've got this the dynamic of the kind of stagflation that I think is going to become more evident in the months ahead, and this continuing rally in equity markets notwithstanding, you're going to see more, I think, of what we had last year, and that is your wealth items are going to stop going up as much. So, meaning stocks, real estate, things like that. Maybe they won't crash, but there's going to be less reason for them to go higher. And yet, what your consumables are still will be going up. Your paycheck won't keep up with it. So, I really do believe that we are going to get to that place, not to beat a dead horse. We've been talking about this a fair bit. We are going to get to that place where even this seeming strength on the part of consumers, even if it is selective, is going to give way to a broader spending slowdown because the money just isn't there. The excess credit and excess savings just aren't there.
No, and anecdotally, I've started to hear that banks are slowing their lending policies. So, if people that are trying to go back in and renegotiate loans are being told no. So that's already starting to happen in the marketplace. So yeah, we're going to start to see some of these knock-on effects. So that lends us to the question, if what we've talked about is going to make inflation continue to go up and probably start to spike again, is the Fed going to continue to raise interest rates in that environment, giving all the knock-on effects to the consumer and the middle class?
Look, I think that again, the markets are giving the Fed the benefit of the doubt for a still expected one more rate hike in July. Whether they do the second one that they suggested recently remains to be seen. It probably won't be for a while, though. I think that the Fed, in its own mind, seems to believe that the lagging but growing impact of what they're tightening has been to date. And if they get cooperation from the credit markets, which again this week kind of went in reverse with the dollar's plunge, which doesn't help them. Interest rates had started to go up, but then they turned around and came down. That doesn't help them. But in their perfect world, they raise rates one more time and then coast for many months, or maybe I heard it suggested today, a year or longer. They're going to keep rates at their terminal level and let that chronically higher level of borrowing costs do its work over a period of time, maybe not overdo things if they haven't already, but let that bite a bit more into consumption, into corporate profits and the rest, so that hopefully in a controlled manner, they bring inflation down more to what their supposed target is. Unemployment will tick up a bit. The GDP may go negative for a little while, but not dramatically. So that's the kind of scenario they've been shooting for all along. They haven't gotten it yet to any great extent, simply because they put so much liquidity out there to begin with that maybe they themselves even underestimated just how tight they were going to have to get and how long they were going to have to do this for before they brought us back anywhere close to where we started, which, look, in the end, for the record, I don't think they're going to manage to do. We are not, barring a global depression, going to go back to the price levels we had prior to the pandemic for a whole host of reasons, geopolitical and others that you and I have talked about before. In fact, I'm eager to find out come next month what is exactly contemplated by the title of this year's summer picnic of all the central bankers out in Jackson, Wyoming, where the theme is structural shifts in the global economy. Okay, so now they acknowledge there are structural shifts. Well, what do you mean by there's structural shifts? And I'll bet you money that to at least some extent, the structural shifts that they're talking about are going to be chronically stressed supply chains, chronically tougher jobs for them to keep the resulting inflation in check from those things. So we'll see what happens. There's been a suggestion that this is going to be a precursor to the Fed having no choice, and maybe the other ones as well. But to say, okay, well, I guess 2% in inflation target in our modern world with these structural shifts is unrealistic. Maybe we need to be more realistic and say that we'll be happy with 3 or 4% and understand that we can't do any better than that. We'll see. That's just, that part of things is just speculation, but we'll find out.
Okay, well, let's speculate down that rabbit hole then. So let's say that's in fact happens, because we've talked about that very scenario where they abandon 2% and reset their target. Will the market, look at that as, okay, the Fed shift has begun, or the Fed pivot rather?
Well, I don't think it'll necessarily mean the Fed pivot has begun. I think it'll be an acknowledgement that we are in this great stagflation, and that there's, the Fed has of course been one of the chief causes, if not the chief cause, if not the only one, of the inflation part of the great stagflation. But even if they try and fight it, they're only going to have a certain measure of success, because on the other end, you've got, and let me use the US's so-called Inflation Reduction Act legislation as an example. One of the reasons that this thing was somewhat laughably entitled the Inflation Reduction Act is because there was some money that was going to be made available to bring about more production of a lot of the materials within the US and or for, with our allies that we need for the so-called green energy transition. And that whole gambit is still way behind. The IEA came out in just the last few days with a global assessment of this, that basically, when you boil it all down, said that there needs to be massively more production of lithium, cobalt, copper, and all different kinds of things, because there's just not enough supply. And so had the Biden administration, in the context still of the US, been more forthright about the level of new development that needed to be engaged, and if they weren't fighting that, then yes, you could say that governments could reduce inflation by increasing the supplies of these things we're short of. That was supposed to be a big part of the point. But when you look at what the Biden administration has actually done as a follow-up to that, and other governments have been as bad in some instances, Canada, the EU, etc. There's not been remotely enough started or permitted, or where you've started the permitting process that's going to meet the needs going forward. So that means that, okay, we're going to have higher inflation because the input costs for everything are going to be that much more because we don't have enough supply. And this, I think, is going to be one of the things that the Fed talks about in Wyoming next month and points to that. And if I was the Fed and the other central banks, I'd do the same thing. I would put this albatross back on the neck of the fiscal authorities and the governments and say, hey, you want the cost of living to be less, get the hell out of the way, and see if they do it.
Yeah, I've always said, government has three roles: lead, follow, or get the hell out of the way. And most of the time, the third is the correct course of action, but they
Yep.
they never seem to follow it. But it's not a surprise to me that you've got governments all over the world writing checks that their ass can't cover. So it's in our country, it's in your country, and the goals that they're trying to achieve aren't achievable unless they put the weight of government behind it. And they seem to be talking out of both sides of their mouth. They say, yeah, we want to push through critical metals, and then they hold up the permitting process to critical metal projects as an example.
Right.
So it makes no sense. We know we want to reduce the cost of energy, yet they won't build pipelines to get the oil that we need to market in the short term until we get to that point where green energy is feasible. So it raises the cost of that energy. Or even worse, in my country, you've got a government that's intent on jamming more and more taxes on energy, which are inflationary to the whole economy. So
Yeah.
again, back to that common thread where I say we got to stop electing idiots.
Yeah, that's very true. But
So
that's what we're saddled with, and that's one of the reasons why going forward, I don't think we're going to end up with the world as being contemplated by the bulls on Wall Street right now.
no, although I feel like this conversation's been like with Mark Faber, a lot of gloom and doom. So we should look a little on the forward side of things. There are going to be opportunities for people to make money, and there's going to be segments of the economy that are actually going to thrive in this environment. We talked about retail sales being in the toilet, retail bankruptcies are up. So I'm going to go out on a limb and suggest that retail is not going to be one of those areas that's going to thrive and do well for people. But I'm going to put the ball in your court to suggest the areas that people should be looking at for growth and opportunity.
Well, look, I think conventional energy has got to be at the top of anybody's list. Generally speaking, energy since the fourth quarter of last year has not been a great performer, even though for most of last year it was a notable outperformer in the bear market environment that we had in 2022. I think that we've turned a corner and we're going back in a direction of a much more constructive energy market because of there is a lot of the Fed talks about structural things next month. Structurally, with the oil market globally, there is not enough new supply on tap, and you've had this, I think, unreasonably low price for oil recently for a lot of one-off reasons. The perception that China's weak, although China has been refining record amounts of crude oil in their country recently, and also keep in mind that in response to the more lackluster economy it turns out that they're having in 2023, they've lowered interest rates. They're going to be doing more stimulus, so that's going to provide some support. Globally, demand goes up to a modest new record every year, pretty much, for oil in one form or another, and without the oil to be there. So you add those two things, and it's economics 101. More demand than supply means that the price goes up. And generally speaking, oil stocks and even natural gas and some of the other stocks are very, very cheap compared to the fundamentals. I especially like, going forward, the theme of Canadian energy stocks, where the fundamentals for a lot of intermediate producers, let alone larger producers, are even better than the fundamentals for a lot of US ones. And where is a kicker, and I'm going out now a couple or 3 or 4 years, maybe, Mike, but a few years from now, I think that despite my view that this beating that the US dollar has taken recently is a gross overreaction and will probably be reversed, we probably have now seen the peak in the US dollar. There's a lot of reasons why a few years from now its exchange rate will be lower. And so if you're buying Canadian energy stocks today with strong free cash flows, high dividends, and in a loonie that in the next 2 or 3 years is probably going to gain 20 or 30% as it gets back toward parity. And I'm talking now, of course, in the context of being a U.S. investor buying Canadian energy. That's gonna just be a license to mint money, kind of like what Elon Musk said about lithium, stocks and lithium plays. Buying Canadian energy for U.S. investor is going to be, minting money for the next few years. And I think a lot of the corollaries of those themes, even though this viewpoint of mine has taken a step backward this year after taking a couple of steps forward last year, I still do believe very firmly, for a host of reasons that you and I have talked about before, that going forward, the new fangs theme, not the old fangs, but the new fangs theme will make another comeback, and it's going to be a bigger and better one each time we get this wave going forward, because whatever else happens in the global economy, you've got to look at the stuff that consumers, businesses, infrastructures, governments, transportation grids, power grids, everything, what do they need? And that is going to become of much more paramount importance in the years ahead. And I think we're in a very, very early stages of most of these stories. We've seen nice moves on and off for a few years in uranium, which kind of led the charge. We've seen volatility, but still net gains in a lot of lithium stocks. Some of the other better base metal plays have done well, but this is only the beginning. And I think that no matter what happens with the big picture of things, those are going to be the things, if you're looking as a long-term investor, do your homework, or look at folks, like Mike or myself that do homework. Look at the better base metal plays, battery metal plays, energy plays going forward, and you're going to be real happy.
Yeah, as we head into what's probably going to be a recession in all of this, I keep telling people, you hear it, it's cliche. This time it's different, and it's generally never different. But this time I actually believe it might be different, because where it won't be different is the governments are going to start to throw money at the problem to try and get people back to work. And given the push towards green energy, I think that money is going to end up going into green projects, which, when we have a deficit across all those metals that are needed to green the economy, I think is exactly what you're saying. In the metals end of things, we're about to see a boom that we've never seen before in our lives, and it's going to be fueled by government infrastructure money to fight the next recession.
I agree wholeheartedly, and as you know, I've said that as well for a while, but that's going to be the icing on the cake later. We're unfortunately very likely to go through a lot more pain first. I mean, last year, when we had the spikes in energy costs, especially natural gas, that was a shot across the bow to anybody with, any functioning brain cells to extrapolate what caused that energy crisis last year into the future, and consider factors like resource nationalism, like the growing risk of war and renewed trouble with supply chains as a result. All of these different things that are going to give us repeats, maybe not just in energy, but in some other key commodities, are going to give us repeats going forward of what we saw with natural gas acutely, and with crude oil to a lesser extent, but still a painful one when gas was over $5 for a while. We're going to see repeats of these things. And, I think that it may take more of those to wake up the governments involved that are supposed to have some wisdom to foresee issues like this and foster the policies to lessen these supply shortfalls and price spikes. We clearly don't have very much of that now, which is why we're probably going to get repeats of those episodes from last year before we finally get some more adults with economic experience and financial experience and just good old-fashioned common sense in charge that say, okay, we should have done this years ago, but now here's the crash course that we're going to embark on to make sure that we get ourselves out from under this mess of chronic shortages of all kinds of key materials. And you're right, by the time that comes along, it's probably going to be in conjunction with the much more notable slowdown in the economy, where everybody's trying to figure out, okay, what do we blow a bunch of $1 trillion on now to try and move economic activity forward again. And the most likely suspects will be infrastructure and green energy spending. So yeah, that's coming. I am quite convinced of that, and it will be, I think, for people that are wise and taking positions now, even though it's very unexciting now. A lot of people are going to make some. You've heard the term generational wealth opportunities. That's what we've got.
Yeah, there's definitely a pivot that's going to occur in the economy. And if you're in front of that pivot, like if you had the sense when the internet was coming to invest in computer chips and personal computers, you would have made generational wealth. We're now at that flex point with green energy. If you have the wisdom to invest in the commodities that are needed to make those batteries to produce that energy so that we have a green planet, that's where your generational wealth is going to come from. I look at the lithium market, and I just did a piece with a group called First Phosphate that's creating a lithium phosphate battery tech in conjunction with a group in Belgium. And one of the things that I note in our discussion as we look across the board against all the battery techs that seem to be going to happen, the common denominators, they all need lithium. So if you're looking at that lithium market, and every single battery combination out there has lithium in it, there's going to be increasingly huger and huger demands on that. And the people that are looking for it now, because lithium was an underused commodity up until now, are going to have, hugely weighted gains.
Yep. So no, we certainly agree on that, even though all the oxygen in the room right now in the markets once again is being taken by big tech and whatnot because of this momentum rally, that's going to flip again, and we're going to go back to that environment that we had last year and then some.
Well, the tech boom right now is all AI. So, if you have AI in your name, people are throwing money at you. It's the same as if you had .com in your name, in the late 1980s, people were throwing money at you.
Yeah, that's a part of it, but I think even more than that, Mike, AI has been the big catalyst, but I think a little bit more broadly than that, there's just this idea that there's still a lot of liquidity out there. Interest rates in everybody's mind are peaking. We're going to avoid a recession, have the soft landing, et cetera, et cetera, et cetera. So everybody wants to get into the highest beta stuff and be early to what they think is going to be a new bull market and eventually new all-time highs for stocks. And so that's the simple, and that eventually wrong, but you can't convince people of that today or tomorrow, but that's the narrative that's driving all of this stuff higher.
Yeah, well, there's a lot of tears when the .com bubble burst, and when the AI bubble bursts, it'll be the same thing. So
probably.
But out of that, there will be the winners will emerge from the rubble, so to speak.
There'll be a few, sure.
Agriculture. We never talk really a whole lot about the agriculture and the agricultural commodities, but given the environment that we're in, is there opportunities in agriculture?
I think there are. I here again, somewhat is the same with energy. You've got a growing global population that wants, needs more food, not less. You've got weather and climate challenges that add another dynamic when it comes to prices for things. And I think just generally that the theme going forward of food is going to be a big one. I don't follow it, I must confess, as much as I do energy markets and some other sectors. So I'm not the expert on this. I do have a couple of really cool story stocks that are doing well in knockoff areas that you put into the agricultural bin. Some of them environmental remediation as much as agriculture, frankly. But yeah, I think going forward, we're definitely going to see. And then, of course, one of the A's in the new fangs is agriculture.
Yeah, it is. The other one is aeronautics, and I always look at that. Yeah, there's opportunities in there, but a lot of that is creating war machines, and I just can't bring myself to go there.
No, I can't either.
I recognize the opportunities, but I just can't bring myself to go down that road. I guess there's limits to where I wish to profit.
Yep.
So also looking forward, what else should people be looking at as the economy does their pivot?
There's so many things. We've already gone a long time today. I think that I choose to use the term, and you've heard me say this before, that we're going into a slow, dull ache of an economy. There's going to be less money to spend, higher living costs, higher borrowing costs, higher carrying costs for existing debt. I still think there's a lot of reckoning to come with things like commercial real estate. Corporate debt is finally starting to show some cracks. The number of bankruptcies is already higher in 2023 through mid-year than it was all of last year, and that's going to worsen. So, and this is something that's going to be with us, I think, Mike, for several years to come. Again, I can't stress enough that the markets cannot see, seemingly, past this binary outcome of choices that they became accustomed to for so long. You had long periods of disinflation, expansion, close your eyes and buy any passive ETF and you made money kind of world, which was interrupted a few times very rudely by one-off sudden bursts of deflation, whether it was going back to 2008 or more recently the self-imposed one in 2020. But then you quickly rebound from those things and it's back to the old ways. We are not going back to the old ways. And that's something that still has not come home to the average investor, certainly. I think the average consumer is starting to figure it out a little bit better than the average investor, but the average investor still doesn't get this. So as you start to see the evidence of this and what we're talking about, that granted right now, we sound like the crazy uncle with the tinfoil hat. And again, that's not because I'm calling for a major bust. I'm not. That's not my base case. My base case is this slow, dull ache. It's not going to be a quote soft landing. It's going to be a slow, dull ache with on again, off again recession numbers, less money to spend, higher borrowing costs chronically for a long time. All of these things we've been talking about. That's the world that we're going into. And people need to understand that as that world unfolds, from an investment standpoint, it is going to be a good thing. Because as we saw the early evidence of, and this was just a foretaste last year, when you had the S&P down 20%, the NASDAQ down by over 30%, and yet there were still some sectors like old energy and some other ones that bucked that trend that did well. You are going to see more of that down the road because when the reality of the long term sets in, and people realize this world that we're going into of the great stagflation, the slow, dull ache, I'll come up with some other names for it, I'm sure, in the months and years ahead. You're gonna have a lot smaller menu of attractive investment options, and understand going into that what that smaller menu is. Learn to distinguish between needs and wants. Okay. It's way too early to do it now, but I would look at things like the airlines that are swimming in money right now, and I'd be trying to figure out, boy, can I find Doc Brown to tell me the day that I should be shorting Delta? And some of the other high flyers right now that are built on the last hurrah for people to take trips and spend money on wants.
Yeah, I agree. And to wrap up after that, Back to the Future reference from the 1980s. I got another 80s reference from the John Larroquette show. In the back in his office, there was always this sign that said, "This is a dark ride." So yeah, it's going to be a long, slow ache, but we will get through it just like a dark ride. So
That's right.
if people want to follow you and hear more of your musings, how would they do so, Chris?
Simply go to nationalinvestor.com and sign up for my newsletter. There's a free version, there's a paid version if you want all of my specific recommendations. But better still, follow me on Twitter at Nat Investor. Every time I put something out on YouTube or elsewhere, I always call attention to it there. I call attention to it when you and I have a discussion, or anybody else too. So that's a good way to follow me on a regular basis, where numerous times a day, and I don't throw stuff out there like a lot of people do just to do it. I'm very selective about what I share, so when I share something, there's a reason for it.
Absolutely, I'm on that list, and there's always lots of gems and nuggets in the things that you do share. Thanks very much for joining me, and I think the next time will be right after that Fed meeting where they discuss the next rate hike or non-rate hike, whichever they choose.
Right. All right, take care.
Thanks, Chris. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.